Welcome to the Daily Market Recap. Today is Friday, June 5, 2026. Ouch, Wall Street just got hit by an absolute wrecking ball. It was the worst single-day drubbing since October, and the culprit hiding in the bushes was a monster May jobs report. Employers added a whopping 172,000 jobs, which is literally double what forecasters expected. While a booming labor market sounds amazing on paper, it triggered an immediate panic attack that the Federal Reserve will be forced to hike interest rates later this year instead of cutting them. Cue the market chaos. When we look under the hood, it was an absolute ghost town for growth sectors. Technology and consumer cyclical stocks were completely obliterated, leading the downward sprint as the market's heavyweights got hammered. Nvidia and Broadcom led a massive tech rout that spared almost no one in AI land. Meanwhile, traditional defensive havens and value pockets like energy and healthcare managed to keep their heads slightly above water, acting as the lonely lifeboats in a massive sea of red. With investors aggressively hitting the panic button, CNN's Fear Greed Index took a swift elevator ride down, currently resting right around 55. We are officially balanced on a knife's edge in neutral territory, but make no mistake about it, the market's vibe is shifting toward fear faster than you can say liquidation. The U.S. Labor Department dropped an absolute bombshell today, revealing that the economy added 172,000 jobs in May. This completely shattered estimates and upended the entire narrative on Wall Street. For months, everyone has been hunting for an excuse for the Fed to slash rates. Today's report gave policymakers a glaring reason not to do it. And macro traders are now genuinely terrified that a rate hike is back on the table. The high-flying AI bubble caught a nasty pin today, driven by Broadcom's muted forward guidance and the hot labor data. Semiconductor equities suffered a catastrophic meltdown. The SOX Semiconductor ETF recorded its worst single-session decline since early 2025, wiping out a staggering $1 trillion in combined market cap in just hours. It turns out that even AI giants can feel the pain when interest rate gravity kicks in. Bonds and equities collapsed together as the 10-year U.S. Treasury note yield surged up to 4.55% following the hot jobs print. With capital fleeing risk assets, Wall Street's true fear gauge, the VIX, skyrocketed by an incredible 40% to hit its highest mark in over 2 months. The market is screaming that a structural regime shift in volatility is officially here. All right, it's time for the daily scoreboard. Let's see who managed to miraculously defy gravity today and who got completely dragged down into the absolute abyss. In a sea of red, these four tickers put on their superhero capes and managed to squeeze out some impressive green days against all odds. On the flip side, these four tech and semiconductor titans took the absolute brunt of today's aggressive tech sector liquidation. Looking at the S&P 500 equivalent, SPY closed down sharply around $738.37, slicing through near-term moving averages. Bulls desperately need to defend the immediate support zone between $738 and $740 to prevent a much nastier technical breakdown next week. On any relief attempt, old support now turns into heavy overhead resistance around the $758 level. The tech-heavy NASDAQ equivalent, QQQ, took a brutal 4.18% punch to the gut, finishing near the $540 mark. The technical chart has turned distinctly ugly here. Immediate support is hanging by a thread right at $535 to $540. If the selling keeps its conviction into next week, a deeper drop opens up, while overhead resistance is heavily stacked up at $560. Small caps weren't immune to the interest rate scare either, with the Russell 2000 equivalent IWM sliding to finish down at $283.35. The absolute line in the sand for the bulls is the major support floor at $280. If IWM can hold this ground, a corrective bounce back toward $290 is possible. Lose $280 and things get very messy. Crypto couldn't hide from the macro storm either. Bitcoin continued its painful grind lower, trading around $62,875 and locking in a 14% loss for the week. The heavy selling is fueled by a record-breaking 13-day outflow streak from spot ETFs. Bleeding billions BTC is holding just above immediate support at $62,000. But the real psychological line in the sand is $60,000. Resistance sits far overhead at $65,000. Ethereum is in an absolute free fall right now, diving nearly 20% over the week. Talk about a brutal stretch. Spot ETH ETFs are suffering an unprecedented 17-day consecutive outflow streak that has completely drained buying pressure. All eyes are now glued to consolidation support at $1,540. If Ethereum loses that, the next stop is a fast slide down to the $1,420 pivot top. With the twin engines of BTC and ETH losing power, the wider altcoin market suffered massive risk-off liquidation. Speculative capital is rushing for the exits as the double whammy of a stronger dollar and surging interest rate expectations hits both digital and traditional boards simultaneously. The market sentiment heading into the weekend is distinctly defensive and highly cautious. Today's massive selling volume and structural breakdown suggest this isn't just a quiet dip, it's a major trend challenge. the easy money days are hitting a serious macroeconomic speed bump. Looking ahead to the next trading week, your eyes must be absolutely glued to upcoming inflation indicators and a heavy slate of Fed speakers. Traders will be microanalyzing every comment to see if the central bank validates this new fear of interest rate hikes. Stay safe out there, protect your capital, and we will see you on the next Daily Recap.